Let's now bring in Strategas partner and chief market strategist Chris Verrone. He's back with us at Post Nights. Good to see you.
Great to be here. Thanks for having me.
So let's just take the trade news.
Yeah.
We're going to have this meeting in London between the two parties and the bill. I mean, how are you thinking about both?
Well, what we've been telling clients for weeks and weeks is one must actually be headline agnostic here. I think that works on both sides because the headlines a week or 2 weeks ago weren't particularly compelling, and they certainly seem more optimistic today. I don't want that to distract us from what the message of the market is. And I think the message of the market is still one that is largely pretty constructive here. New 3-month high for the S&P today. That comes on top of the NASDAQ last week making a new 3-month high. Those are generally pretty bullish conditions. Maybe most importantly, cyclicals continue to hum along. I know the data on balance has been softer. The market's saying ignore it. Cyclicals making new highs versus defensives says, hey, the economy's largely okay here.
How can you possibly be headline agnostic? How can you tell us that we need to be?
Yeah.
When the future of the trade war and the future of the tax bill matter more than anything else, arguably?
Because I think every single market message that we've seen since basically the lows back in April is telling us, think what could go right, not wrong, over the next 6 months. I'll give you some examples. It was a month ago we were on your show. You got the big expansion in 1-month highs. 60% of the S&P made a 1-month high. You look at that data historically, it says forget whatever you were thinking and think about what could go right over the next 6 months. So let's put a check there. We've recovered 80% or 85% of the entire decline. There's really never been an instance historically where you see big weakness after recovering that degree of the decline. And I think the leadership message, financials continue to hold their own, industrials continue to hold their own. That doesn't sound like a market that's terribly concerned about the economic consequences of what's going on with trade.
Doesn't matter, though, the method to why we got that bounce back? It was all because of the rollback of the tariffs on China. We're not having this conversation today if that doesn't happen, are we?
Yeah, you know, I think it's a fair point in the context of this was trade-induced on the way down, and it certainly seems like it was trade-induced on the way back up. But what hasn't really changed this whole time, pre-April 2nd and post-April 2nd, is the momentum stocks continue to lead. So in a lot of respects, Scott, the world looks very familiar to what we knew before April 2nd, post-April 2nd.
Did we like the way things looked then before April 2nd, and the fact that if tech was going to be leading, you'd still have the naysayers saying, well, I mean, this can't go on forever. Their growth rates are, in fact, slowing. Maybe their multiples aren't justified at current levels as a result of that. Yet here we are with the NASDAQ up 10.6% in a month.
And I think what's most notable about that move in tech discretely or NASDAQ more broadly, look how the composition of tech is starting to evolve here. For the last year, it was own software, sell semis. That is starting to change here. All of these analog semis, many of which were down 40, 50% over the last year, all getting better. KLAC, Lam Research, Micron. The Kospi broke out decisively over the last week or so. It's a message on global growth. It's a message on S&P earnings. It's a message on semis. So I think, if anything, tech has basically shown itself to reaffirm itself as the leader in this market. I think very constructive signs coming from tech.
I mean, it's semis have bounced back. Yeah. It's semis have been working so well. Software's been working so well. It's kind of everything within that universe has been working so well, including so-called old tech. Yeah. Like the IBMs of the world.
IBM, Cisco, Oracle. There was one point 2 or 3 weeks ago, you had more tech stocks make a 1-month high than at any point in the last 20 years.
Wow.
That is bullish, not bearish. So I know it's tempting to look at this week's headline or last week's headline and get very wrapped up. I think the market is telling you look through it. The conditions we're seeing, whether it's credit, whether it's leadership, whether it's cyclicals, generally occur in bull markets, not bear markets.